What's up, guys? I'm nobody special, and I just got done going for a dip in the pool because the air conditioning is out in my house. I need a new motor for the blower in my air handler, and supply chain issues. It's taken a couple of days to get the part, go figure. So it was really hot in my house today. So I was just sitting here going over the big sell-off that happened in gold and silver last night. And it's time for me to eat some crow, because I went on a video a couple of days ago or a couple of weeks ago and said gold and silver prices were set to soar. And I laid out my case for why I thought gold and silver prices were set to soar. The Dixie was down, real yields were way down. The reverse repo market and the draining of the Treasury General account, all my reasoning, and I was very convinced of my rightness in that trade. Of course, most people are usually convinced that they're right. Well, the data says otherwise. The data says nobody special was wrong, because gold is way down. And so I guess I got to own up to that one, right? If I'm going to gloat when I get the call right, I better eat crow when I get it wrong. So I'm sitting here going through the data, trying to understand where I went wrong and what the data points were. And this move down in gold and silver, there were a couple of data points that supported it. I mean, we had the Dixie has risen a little bit, especially on the back of that jobs report we had last week. The jobs report came in pretty good. Coincidentally, wages are starting to rise, and I have been mentioning that that is the final straw in this inflation narrative, is that wages have to go up to get people to come back. And we're starting to see wages rise, and we even saw a data point today that said there's more job openings than there are people to fill them in this country right now, which means there's plenty of work. People just don't want it because it doesn't pay enough, because inflation is going to force those wages to rise. But back on the gold subject, there was some fundamental support for this move down in gold, at least some of it, right? Because yields have crept back up. You know, we're back at about, was it 1.3 on the 10-year? We were down around 1.17. Real yields have come down from a low of minus 1.19. I should say they've come up to minus 1.06. But I mean, historically, negative 1.06 on a 10-year real yield, that's still astronomically low. That is ridiculously low. All the fundamentals still support gold prices should be higher. So I'm trying to understand what happened. Now, a lot of these gold bulls and silver bulls like myself, we get a lot of heat because every time the price goes down, we're always so quick to say manipulation. It was manipulation. They did it. You know, they in air quotes, which, you know, I hate to be asked who is they, as if they're expecting a name. So I didn't want to just automatically go to they this time. I didn't just want to do that. So I'm trying to come with a simple explanation for why gold prices went down. And Occam's razor, I'm a big proponent of that. The simplest explanation is there were more sellers than buyers. Price goes down when there is more supply than demand. But the more I look into that, and the more I look into the timing, you see, Occam's razor in this case falls apart when you look at the timing of this trade. You see, what happened yesterday, as soon as futures started trading, 6 p.m. Eastern time on a Sunday night, 24,000 gold contracts, paper gold contracts, were put up for sale all at once. They were just dumped on the market. And this also came on a holiday in Japan and Singapore, so there were almost no traders in Asia at work at this point, which meant this was absolute minimum liquidity time in the market. Now, you have to start with the premise of people selling something want to get the best price for what they're selling, right? Nobody sells something with the goal of losing money. And this is where Occam's razor falls apart, when I try to come up with the simplest explanation that there were just more sellers than buyers. Because you have to assume someone who's selling 24,000 gold contracts, okay, that's $4 billion worth of gold. You have to assume that a trader who handles that kind of money is not a flaming imbecile. Maybe that's a big assumption because we have flaming imbeciles in Washington handling bigger sums of money than that. But let's begin with the premise that someone who trades in and out of billion-dollar gold positions is not an idiot. Okay, so if we assume he's not an idiot, then why did he sell it all at once at 6 o'clock on Sunday on a weekend when there was no one in the US trading and when the people in the Asian markets were on a holiday? Why would he do that? And then you start to realize that the goal of that sale was not to get the best possible price for what they were selling. You see, if you begin with the assumption that these are intelligent people doing these trades, then you have to realize if their goal was to get the worst possible price for what they were selling, then they handled that trade perfectly. Because they sold when there were no buyers. Nobody was awake. As a matter of fact, if they had made that same trade today, midday, it would not have had a fraction of the effect on the gold price that it had. But what they did was so perfectly timed with the holiday in Japan and Singapore and with the Americans mostly enjoying what's left of the weekend. And with the little bit of negativity that was already going around with gold because of the big jobs number, then they handled it beautifully. And they knocked $100 off of the price of gold in minutes. And do you know what that did? That triggered margin calls. You see, most people who are trading in these futures contracts don't have enough money to actually trade in and out of these positions. They're not taking delivery, they're settling in cash on paper. And a lot of them are borrowing money to take out these long positions, which means if those positions go too deep in the red, they're automatically sold. They're margin called out. Better yet, some people who do have the money invested in these trades want to protect it. So they put stop loss orders in, which is a automatic bailout order, where if the price goes so low, quick sell it before I lose any more. So if your goal was to get the worst possible price, you have to think, why then would they want to get the worst possible price? And that was to trigger those margin calls and to trigger those stop losses. And if you watch how that trade went, it dove hard, fast, like lightning. They're calling it a flash crash. It wasn't a flash crash. It was a flash dump. It was price manipulation at its worst. And then as soon as those margin calls and stop losses started getting triggered, you notice the price came right back up. That was the same people who sold that $4 billion worth of gold started buying it from all those poor people who got margin called, who got stop lossed. So again, if you look at the timing of this trade and you begin with the assumption that these were not idiots making the trade, then Occam's razor says the goal was to get the worst possible price. And then you see what happened, and that's why gold bulls will say manipulation, and they're right. And you have to, I keep thinking, why do they keep getting away with this? It is so obvious what they're doing. It's so blatantly obvious. Why don't the regulators do it? And then you start to think, who benefits? Again, the simplest explanation. Besides the crooks who are stealing the money, and they are crooks, they stole hundreds of millions of dollars last night from unsuspecting traders who got margin called and stop lossed. Hundreds of millions of dollars were stolen in broad daylight for all to see, and the regulators did nothing. So why do the regulators do nothing? Well, who else benefits from low gold prices besides people who are short gold? Could it be central banks? Because right now, there are two kinds of central banks in the world. There are the central banks like Russia and China that are buying gold hand over fist, so they would just love a lower gold price so they could accumulate more. And then there's the inflation-denying, fiat-printing JPOW central banks that need a smokescreen to keep printing their fiat, to keep devaluing our wealth. And they need low gold prices and low silver prices to keep up that charade. So there's your answer as to why it's allowed to happen. Because besides the crooks who are stealing the money, the governments benefit, the central banks benefit. So that's why your gold bulls and your silver bulls will cry manipulation, because that's exactly what it is. And that's the simplest explanation for what happened. And while it is as simple as there were more sellers than there were buyers, you have to realize the reason there were more sellers is because the crooks were doing it in broad daylight. And they were doing it with fake gold. And they were doing it with the sole purpose of manipulating prices lower, which is a crime that is illegal. And the regulators allow it to happen because it benefits the government. So guys, I gotta eat some crow. I was wrong on that call. Gold and silver were not poised to soar. They were poised for another price smash. And I can't tell you the same thing isn't gonna happen tomorrow or the day after or the next day. All I can tell you, and I'm not a financial advisor, don't touch a trade based on what you hear from me, but you'll hear me over and over again say stick to the physical. Don't get involved in derivatives. If you get involved in derivatives, whether it's futures or options, or if you go out on margin, then you're at risk of these crooks doing this and you getting automatically stop lossed out against your will and having all your money just stolen from you. And I do mean stolen. It is theft. So that's all I got today. There's a lot of other stuff going on in the market. AMC had a good earnings report. I mean, that's another thing. Like, speaking of AMC, I mean, they invented dark pools for the sole purpose of being able to move in and out of large positions without affecting market price. So you would think if you're one of these big gold traders and you're trying to get the best bang for your buck selling $4 billion worth of gold, there are avenues for you to do that without negatively affecting the price. Unless negatively affecting the price is what you're trying to do. That's why it was the simplest explanation. Anyways, we'll see what the market holds for AMC tomorrow. We have a CPI read coming out later this week. I honestly don't know what to expect with the CPI read, because car prices have kind of leveled off. They're still going up, but they're not going up as fast as they were. And we did have a lot of the commodities pulled back. Lumber obviously pulled way back. But a lot of the grains and other things pulled back because they just ran too far too fast. So part of me thinks we might actually get a pretty tame CPI number this month for the June reading. Or it'll be the July reading. But then again, you're starting to see these wages going up, and I think the wages going up is going to lead to higher prices, especially in the service sector and, you know, at hotels and restaurants and things like that. So I really don't know what to expect from this CPI number, but I don't expect it to blow us out of the water. I don't think it'll be bigger, or it certainly won't be much bigger than the last one. I think inflation is due to slow, not reverse, but just to slow before rocketing higher, because what these things going on in the supply chain with the shipping costs and obviously the wage pressures are going to continue putting upward pressure on prices for a while now. But that's coming out on Wednesday, so we're looking forward to that. All right, guys, that's all I got for you today. Live small, dream big.